Welcome back to another video. In this video, I'm going to show you where do you place your stops. What is a proper point to place your stop losses? So we are going to go over what is a stop, how do I properly set stops, mental stops versus hard stops, stops and market makers. By now, everyone should have a solid idea and a solid understanding that before you take on any single trade, you should always know where you want to exit for a loss. You should always protect your downside. You should always have a stop loss. So in this video, I'm going to break down a proper level to actually place your stop loss. So if you are familiar with placing your stop losses, how to place it, that's good. But this next step is where do I place it? Right? Because knowing or having the understanding of placing your stop loss is only half of it. The remaining half is knowing where to place your stop loss, and that's where a lot of people mess up. Right? So first and foremost, just to recap, what is a stop? So a stop loss is an order that exits your trade once a certain price level is reached. So the whole idea of a stop loss is, let's say you take this trade and you buy the stock here, right? Let's say you buy at point A. You should always have an exit plan. Okay, what point does a stock need to go to for me to exit? I need to protect my downside. That's always my first goal. I want to protect my downside. Ignore your upside. What is my downside? Is it protected? And that's where a stop loss kicks in, and stop loss says, you know what? If you're wrong, you only lose this much opposed to losing this much. Now, what is the logic and nature of stops? So the logic and nature of stops goes by this. So you don't want to just randomly place stops based on how much you want to lose. A stop loss order should be placed at a price level where it cancels your trade idea and where your anticipated trade scenario is invalid. So the idea is to place your stop loss at a level that showcases you are wrong. That if the stock gets to this point or below or above this point, that means I am wrong. That's the whole idea of a stop loss. A lot of people do not know where to place the stop losses, and they end up getting in or out of bad trades because of bad stop losses. So if you guys take a look here, these are some of the types of stops, right? We have a stop loss, a market stop loss, a stop loss, limit stop loss, trailing stop market order, trailing stop limit order. Just to recap, these two are obviously the same. These two are obviously the same. If you have a market order, that just means that once the stock gets to 10, it's going to trigger a market sell order. If you have a stop loss, that's a limit. That means once it gets to 10, what limit do you want to sell it for? Same thing with the trailing stop, market or limit, right? Do you want to sell it for a market price? Do you want to sell it for a limit price? So these are like the main four stops that people primarily use. Knowing which one to use and knowing which scenario to use it in is extremely important. Obviously, if you're day trading, I would recommend using this. If you're swing trading or trading a stock that's trending, I would recommend primarily using these. Just one fun fact about stop losses, you do not get charged any commission or you don't have to pay any fees until the stop loss actually triggers. So if I buy a stock at 10, right, and I put my stop loss at 9, I do not get charged any fee or any commission or anything until it actually goes to 9. Now, let's say the stock goes from 10 to 12. I can move this up a million times and I will not get charged any fee or any commission until it possibly executes. All right. Just some key points about stop losses. Always determine your stop placement in advance. So before you guys take a trade, you should know where your stop loss is. You should know that, hey, if I get into this trade at $10, I'm going to exit at 9. If I get in at 9, I'm going to exit at 8.50. Whatever the case is, you have to know this in advance. You need to know where you're going to take a loss. Before every single trade, this needs to be established. Don't place your stops at levels where you are trying to make the market fit your framework, right? This is where a lot of people mess up. They place stop losses based on how much they want to lose. Your stop loss should not be based on how much you want to lose. Your stop should always be placed at levels where it cancels your trade idea and showcases you are most likely wrong. So for example, if let's say I have a chart, okay, let's say the stock keeps going below 10, right? This is $10. Let's say the stock keeps hitting 10 and keeps bouncing off it, right? Now, a good stop loss would be somewhere under this. I'd give myself some space, and I'll show you why the space is important. I'd give myself some space, and I would place it there. Some people, what they do is they buy the stock at, let's say, 10.50, and they go, you know what? I only want to lose 20 cents on the trade. Like, I only want to lose 20 cents. Since I want to lose 20 cents, I'm going to place my stop loss at 10.30, right? On paper, this looks good, but in reality, you're going to get stopped out. You're going to lose money on a trade for absolutely no reason. This would make a lot more sense because if the stock gets to this point, there's a higher probability that it's going to maybe keep going down, and your job with the stop loss is to protect that additional loss, right? You should move your stops when necessary. Do not keep your stop stuck at one point, especially when you should move it, right? So when you should move your stop loss, right? Let's say you buy a stock at, let's say you buy a stock at 10, right? You have a stop loss at 9. Stock is now at 15. Your stop should not be $6 low. Your stop should be moved up, and these are things where you have to be self-aware and understand. This is where your risk-reward ratio kicks in. This is where you have to put the pieces together more and understand. It doesn't make sense for me to have my stop at 9. But now, if you buy a stock at 10, right, and the stock goes to 10.20, I'm not going to move up my stop loss 20 cents, or I'm not going to move it up to 10 because that doesn't make sense, right? So very important to understand that. This is where you have to understand what's necessary. Do I move it up? Do I wait? Is this an appropriate time? And as you practice more and more and you put in more screen time, you'll get very familiar with that, okay? Last key point about stop losses is market makers can see your stop losses. So when you guys place a stop loss, market makers can see your stop loss, and I'll show you why this is a very important thing to keep in mind, okay? Now let's go over some examples on how to place a stop loss. When you're placing a stop loss, like I just mentioned, you want to place it at a level where you're wrong. See, every time the stock gets around 200, you can see what happens. It goes up, right? So at this point, I'd want to give myself some space, right? And the reason I want to give myself some space is because since market makers can see your orders, if I have it stop at 199 and it's kind of close, market makers might bring it down to 199 and bring the stock back up. And I'm pretty sure a lot of you have seen that happen where you get into a trade at, let's say, $200. You put your stop loss very tight at, let's say, 199.50. You give yourself very little wiggle room. So what happens is market makers drive the stock down to 199.5 and then boom, they go right back up. So they're stealing your shares. And yes, they have availability to seeing your orders. They can see where your stop losses are because your broker provides them this information. So make sure when you are placing your stops, you give yourself some space, guys, right? So in this situation, if the stock obviously gets down here, that means we're wrong. There's a higher chance of us being wrong down here opposed to this area because this area is very, very close to our critical level, right? Now, how to place a stop loss order, just to kind of give you a quick guideline, is determine your trading style. The tighter you trade, the tighter your stop, right? If you're day trading or swing trading or scalping, whatever you're doing, your stops are going to be different in each and every single scenario, right? If you're swing trading, your stops should be wider and should be formed on a longer time frame, right? If you're day trading, your stops shouldn't be as wide and should be moved accordingly. So for example, right, let's say I'm trading a stock that's at $10.50. Let's say I'm scalping it. Scalping meaning I'm trying to make 10 cents or 20 cents in the next minute or 2 minutes, right? So I get in at 10.50, I'm aiming 10.70 for a quick scalp, but this stock has major support at 10, right? Since it has major support at 10, what the ideal stop loss would be okay, 10 would be my ideal stop loss. But since I'm scalping, I might look to have a stop or exit point at 10.45. Just giving you a random example, right? It might be 10.45 based on some prior information. So I might say 10.45 makes more sense. Now in this situation, 10.45 is gonna make more sense only because of the way I'm trading it, right? I'm trying to scalp it. I'm trying to scalp the next 5-10 minutes, maybe 1 minute, whatever the case is. So I'm trying to capture a quick move on the upside, and I'm willing to risk a little on the downside, right? That's in the next 5 minutes, 10, 15, whatever. But now, If it's different where, let's say I'm swing trading this, I'm holding this overnight, or I'm playing it as a longer play, right? Now if I place it at 1045, the stock can do that and stop me out. So at that point, a stop below 10, maybe a 9, maybe a 920 would make a lot more sense. So you have to understand how you're trading, what your trading style is, so you can determine the proper stops, what time frame you're trading. Obviously, the smaller time frames you trade, the tighter your stops are going to be. The bigger time frames you trade, the wider your stop is going to be, right? Now, here's another example. Now, if you look at this stock, Apple obviously made a nice move up. Now, what you have to understand about stops is if on paper, some things may look good. So on paper, it may look very good if I say I want to short, I want to make money on the downside, I want to put my stop here, and I'm looking to take profit here. So it's like, wow, this is your potential profit, that is your potential loss. So that obviously makes a lot of sense. But what you have to understand is what direction does the stock have a higher probability going in? I think the stock has a higher probability on continuously going higher and higher because look, it's already consolidated, already broke out, consolidated, and it's trying to break out again. And just to kind of go over a little chart pattern, if you guys take a look right here, you can see what's happening. Ascending triangle. Strong move up, gets rejected, buyer step in, buyer step in, buyer step in, boom, strong breakout, right there. Right, very strong move, right? Just to kind of put out chart patterns so you guys can see that whole play right there. But overall, that's the first step, right? Second step is, obviously we're identifying that what direction is going in. I wouldn't short this just because the shorting risk to reward looks good, right? But what if this continuously goes up? A trade could be either A, the stock breaks this A level, I put my stop, and I take the trade from there. B would be I wait for the stock to get back to 240, I see how it reacts around 240, I give myself some space, and I put my stop loss over there, right? But I wouldn't look to short this because of the direction of the stock. But now let's say the direction of the stock is reversing, some midday catalyst, the news came out, cool, now my stop would be placed there. I would give it a little bit of room. I wouldn't put it right at 240.88 because that's too tight, right? A lot of other people are playing that. I'd maybe put it at, let's say, 241.10. Why? Because if it can break that 241 area, there's a high probability it may keep going up, and I don't want to just get stopped out and have a stop loss very similar to other people. Here's another example. Looking at Roku. You see Roku, critical level on Roku right here, critical level, critical level. Let's say you wanted to take this trade. Stop would go a little bit above that. I wouldn't put it at 139.40. I'd maybe put it at 141. I'd give myself a $2 move. I'd give myself a $2 move because I wouldn't want to get stopped out for absolutely no reason. So I want to have some wiggle room. I like to have wiggle room if I'm trading. This is a daily chart. Since it's a daily chart, it's a little bit different. Like I said, I'd be comfortable in giving myself a $2 move, right? On Apple, it was a little bit different, right? So if you guys take a look at Apple, you'll notice Apple was a little bit different. Apple is a 5-minute chart, so I'm not going to give myself a $2 move, right? I'm going to probably give myself a 60, 70 cent move, right? Because I'm trading it on a much, much smaller time frame. So that's the difference that you have to understand when you're taking on these type of trades. Next, using ATR to place stops. So you guys can use the ATR, average to range, to place your stops. So for example, if you look at Twitter, Twitter is at 40.15. The ATR is at $1.13. So what some people do is they're like, you know what, I'm gonna put my stop 2x ATR. So since the ATR is at $1.13, that's the true range, 2x of that is about $2.26. So I'm comfortable in putting my stop a little $2.26 below 40 bucks. So that may be $37, right? That's where the 2x ATR comes in at, around 37. Now, since it comes around 37, not exactly 37, a little higher than that, but let's just hit 37, 38, right? At that point, what I would do is, okay, what makes sense? Does 37 make more sense, or does 38 make more sense? So when I look at it, I would say, hey, it came to 38 last time, so you know what? Maybe at 37.7, 37.8, I'd put my stop. It's giving me a 2x ATR. It's 2x the average true range. And what that means as well is that if I put that, it may take at least 2 days to get there, 3 days to get there. So I'm obviously giving myself a lot more room, right? Also, this is if I'm maybe swing trading it. If I'm day trading it and I'm trying to capture 50 cents, I'm not gonna put my stop loss all the way down here. That's way too low, especially because I'm trying to capture 50 cents and I'm giving away $2. Just doesn't make sense. So the ATR, once again, is something you guys can use to actually place your stop losses. It'll show you what the average true range is. Some people use 1x, some people go 1.5x, some people do 2x. That depends on you. That depends on what makes the most sense. In this situation, obviously 1x wouldn't make sense because 1x would make it $1.13. So 40 minus $1.13 is gonna put us around high 38s. Over there, I wouldn't be so comfortable in putting my stop there. Maybe somewhere below that, because you can see stock got faked out 2 times, right? Obviously, we have our support at 39.13, but maybe somewhere around there would maybe make a little bit more sense. Here's another example, right? So in this situation, stock Tesla, daily chart goes up, it's having a pullback, right? In this situation, let's say I want to use the ATR. I'm like, okay, ATR is $8. So if I put the ATR at $8 and the stock is at 253 right now, right, and a minus is 8, that gives me a number of 245. So what the ATR is telling me, if I use it at 1x ATR, I should put my stop loss at 245. Now, does 245 make sense? It kind of does make sense. Why? Because I have a critical level at 250 and I'm giving myself some wiggle room. So that would kind of make some sense because it's saying that stock fluctuates on a daily basis of $8. So if tomorrow it fluctuates around $8 and does go below 250, it's still in this range of the ATR. So having it at 245, maybe 244 would give me the highest probability of staying in and not getting stopped out by the wrong reasons, right? But some people, what they do is they just put it below 250. But once again, if you're putting it just below 250, it depends on how you're trading it. If the stock gets to 250, right, and once the stock is at 250 and you want to day trade it, yes, obviously putting it at 245 would not make a lot of sense. So these are things which you guys have to be aware of. So when you're trading, guys, I want you to be aware of these things, right? It looks like a lot of information, but I promise when you start becoming more aware and you start thinking about everything, it'll start making a lot more sense. Now, let's go over mental stops versus hard stops, right? So this is a problem a lot of people have an issue with, right? So what are mental stops? Mental stops are stops set in your head, but not actually placed on the platform and require you to manually exit the position. So a mental stop basically goes like this. And I don't recommend mental stops for a lot of people starting out. Being able to be at a point where you can use mental stops takes a lot of time, a lot of discipline, right? So let's say you buy a stock at 10. You say, hey, if the stock gets to 9, I'm gonna sell on my own. Now, the problem with that is what tends to happen with most people is when the stock does get to 9, they usually never sell. They're like, oh, I'll wait a little bit more. I'm not gonna sell, let me wait. It's at 8.80, I'll wait. It's only 20 cents, I'll wait a little bit. Then it goes to 8, then 7, then 6, then 5, then 4, and now you're down 60%, right? Because you chose to use a mental stop. Right? It's very hard, guys. Trust me on this. Very, 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 very hard for you to actually execute on a mental stop, right? Very hard to get yourself to that mental level where you're like, okay, I said 9, I'm going to do 9, right? And for people that have traded, know what I mean. And for people that haven't traded, trust me and believe me, it's not easy. It's very hard to get yourself to that point. So the next type of stops are hard stops. Hard stops are stops that are placed through the platform and will automatically trigger on its own if or when the security gets to the predetermined price. So hard stops are basically me buying a stock at 10 and putting my stop loss at 9. Meaning if the stock gets to 9, the platform will automatically sell. That's what I recommend for you to do, especially when you start out, right? Do not use mental stops when you start out. Not the greatest ways to play stops because it's very hard to get yourself mentally at that level. Now, the downfall of using hard stops is, like I mentioned, market makers can see our stop losses. And since market makers can see our stop losses, sometimes they might take your shares and make the stock go back up. What do I mean by that? So if you guys take a look here, this is market makers and stop losses. Right? So support level, stock hits support, it goes up. Stock gets to support again. You and other people are like, you know what? I'm going to take this trade. Why? Because it looks very good. So a lot of other people alongside with you place your stop loss right here. Since you guys place your stop loss right here, what market makers do now is they tip the price below that area and they stop everybody out. As they stop everybody out, they then drive the stock right back up, taking your shares, creating liquidity, and they profit on the way up. That's where hard stops kind of have a downside because market makers can see it. But me personally, I would still recommend for you guys to get stopped out, right? And then always get back in. Once again, get stopped out, but you can always get back in. Because if it keeps going down, let's say this is $15 and the stock goes to, let's say, 12, and you're like, oh, that was just market makers, but it actually wasn't, you're down 30, 40% on the trade. And that's not what I want. I'd rather have you take the stop. I'd rather have you get stopped out, follow your risk management plan, and then always get back in. And obviously looking at level 2 and time of sales, at times you can kind of read these fake outs and read the market manipulations that are happening with price. And obviously as you get better and better with that, you'll be able to get to a point where you establish hard stops, where you establish mental stops instead of using hard stops, because you get so good at it, you get so good at reading it. But starting out, I recommend using hard stops, guys. All right, so let's take a look here at an example, right? So let's say right here, we're looking at stock Facebook, right? So Facebook is obviously selling off, so I'm looking to short Facebook. So since I'm looking to short Facebook, I'm looking to get into a solid entry. Based on price action, I've noticed there's a lot of demand here. So what I'm looking to see is I'm looking for stock Facebook to break this level on a strong breakdown, and I'm looking to short or maybe buy puts, right? Depending on whatever my trading strategy is, or depending on whatever I'm trying to trade. So let's say Facebook kind of breaks, right? Obviously on the first one, it was a little bit fake, but let's just say we see a strong break. We see a strong break, get in, put your stop around there, right? So at that point, since you have your stop around here, this is how much you're potentially losing. Now, once the stock continuously starts moving down and down, so what I'm going to do is I'm going to apply a line right there, just so you guys can see. Put my stop right there. I'm going to change the color to red, right? That's my stop, right? As the stock starts moving down and down and down, what you need to understand is at this point, especially from day trading, your stop needs to be moved. Where would I now move my stop? In this situation, if that's my first point, right? My second point or second level of my stop loss would be around this level. This is my critical level. Why is this my critical level? Because you guys should be able to see and recognize the price action concept right now, right? Where, hey, it's selling off, it took a break, it bounced, and it's going down again. So I know that there was some sort of buying pressure here. Since I know there was some sort of buying pressure here, that becomes my next level. Since that's my next level, I would give some space around that level. I wouldn't be exactly at that level, but I give myself some space and say, you know what? This is going to be my second stop. Basically, this was my first stop. That stop is now moved down, right? Let me remove this. That stock is now moved down to this point. Why is it moved down? It's moved down because if I keep my stop at this current level, I'm exposing myself to too much risk at this point. I'm putting out too much risk. But now if I move it down a little bit, I'm not exposing myself to as much as risk as there was initially. Now as the stock keeps going down, right, I'm like, you know what? This is where it's bouncing off. Since it's bouncing off right here, this becomes obviously another level. That's where buyer stepped in. Boom. Where can I move this stop down? And I start locking in profits at that point. Keeps going down. All right, as it keeps going down, boom, it stopped me out right here, and I'm totally fine. That's if I didn't take profits anywhere here. Obviously, some people are gonna take profits at this point because you're getting a strong move down, a strong breakout, and they're like, you know what, I'm pretty happy with my profits, especially if I entered somewhere around this point. So that's going to be a very, very strong and great move at that point. But recognizing that is extremely, extremely important, guys. So if you guys take a look right here with Tesla, same exact example. Let's just say we see buyers, and very basic example, but let's say I'm like, you know what, if it breaks 258, I am going to look to short. Tesla breaks 258, I'm like, all right, I'm gonna short. So first thing I do is I put in my stop. Now remember, I'm gonna give myself some space, right? I'm gonna give myself some space in the move. I'm not gonna put a super tight stop. That's where a lot of people mess up. They put a very, very, very tight stop, and that tight stop ends up messing them up. So I'm gonna put my stop right there, right? Most people, what they do is they go, I'm gonna put my stop right there. That's bad because the market makers can easily take your stop, right? They can take your stop out, or they might fake you out. So I'd rather move it up and have some space. Stock goes down. Now you can see right here, if this was a real trade and I had my stop loss here, market makers would have maybe possibly taken me out. But since I maybe gave myself some space, it makes it a little bit harder for them. You can see stock breaks down, it's consolidating. I realize my next levels. I'm like, okay, if it breaks below this, I can then remove or lower my stop. See how it breaks? I take my stop and I'm like, there we go. Move up my stop, and then same exact thing. I get stopped out, whatever the case is, I'm fine, or I take profits here depending on my trading style and trading technique. All right, just to recap everything, guys, setting stop losses are extremely important. Starting out, please do not use mental stops, use hard stops. If you get stopped out, or if you're getting stopped out on a lot of trades after you journal your trades, your stop losses are probably at a bad point, and the only way you're gonna realize they're at a bad point after you start trading with real money. Paper trading won't show you if your stop losses are at a bad point or not, because market makers do not exist in paper trading. So when you guys start off with real money and you do place your stops, you'll start noticing, hey, I get stopped out a lot. Hey, I'm having this issue, or I'm having that issue, and then that's where you slowly start improving. Setting stop losses, once again, should always be at levels that showcase you are wrong. They should never be levels where you're trying to say, I want to lose 50 cents or $1 on the trade. No. Stop loss should be, where does this stock have to go for me to be wrong? And getting better at that, once again, takes a lot of time. And as you progress and you're aware and you understand everything, I promise things start getting a lot more better, and you start getting better at where to place your stop losses.